constraints that are causing inflation to contribute to inflation are still there. And so all the money that was printed is still mostly in the economy, especially now that I think we're getting towards the end of quantitative tightening. That removed some money that was printed, but only a small portion of it. Most of the money that was printed is still out there. We still have not had really a capex cycle in energy or commodities. We've not brought new copper mines online at scale. We've not brought new oil fields online at scale. We're seeing some obviously development around LNG export capacity to, for example, reduce Europe's reliance on, now that they've been severed from Russia, they need more LNG. So obviously there's work being done.
Lyn Alden is a well-known economist and financial strategist who has offered her opinions on a number of economic issues. In this video, Lyn Alden talks about the difficulties the labor market is currently facing, such as the impact of automation and the continued supply chain disruptions brought on by the epidemic. She also voiced cautious optimism about the status of the economy, pointing out that although there may be short-term volatility, the long-term outlook is favorable, given that policymakers can implement efficient measures to solve current difficulties. She went on to discuss the most recent unemployment claims and the potential effects they would have on the economy.
Well, it shows some degree of deterioration. And I think if you zoom out and look at the continuing claims, that gives a clearer sign of labor market deceleration. That's been a more steady march upward since late last year. And when you look at economic indicators as a whole, right, you can watch them in rate of change terms, right? Rather, before they go negative, they start decelerating at a positive rate. So they've been accelerating, then they start slowing down while they're still growing. And some of them tend to be more leading than others. And so you see things like manufacturing activity start to slow down early. You see other signs of liquidity start to slow down early. And the labor market tends to be one of the later signals. It's kind of lagging or coincident with recession by the time that really rolls over. And so that has been one of the more resilient areas in the economy over the past year, really, as you've seen a lot of other things decelerating since late 2021, and labor's held up, which is not unusual for that to be kind of on a big lag. What made this cycle somewhat unusual, though, is that a lot of times you see labor weakness in some of the lower income type of jobs. Whereas in this environment, because certain sectors are so interest rate sensitive and interest rates have really been what's driving this kind of deceleration, you've seen the layoffs more in tech, more in real estate, finance, kind of these types of areas where, if anything, some of the lower income jobs are still facing shortages, still facing outright shortages in some cases, and I think the wages are going up rightfully. And so you see kind of a bifurcated market, almost two different types of economies out there. But I think that we are kind of increasing evidence towards recession, and some of these recent labor market prints are kind of pointing that way now. I don't know about all industries, but I do think it is broader. I think you can only have so many one-offs until it's clearly a trend. We've seen that in tech. We've seen that in parts of finance. It is interesting that it's starting to hit some of these less interest rate sensitive areas. In some cases, they did just accumulate extra labor compared to what they needed. Especially when labor is scarce, you kind of hire first and figure it out later. So I think there's some of that normalization, and some companies will be more affected than others. But I do think we're starting to see kind of a broader deceleration. And like I said, it won't necessarily impact every industry, and it certainly won't impact them all equally. But I do think it is that things tend to spread because, for example, those laid off tech people, they will travel less. They'll go out to restaurants less. They'll there may be not directly impacting something like McDonald's. That's a broader story. But basically, when you see people lay off one sector, even if other sectors are not the epicenter of it, even if they're not being hit as hard, they're still impacted by other people losing their jobs. So I think that certainly labor pressures, higher wages, incentivize more automation. I think that's been really clear in the grocery store market, where you see fewer and fewer human cashiers and more of those automated checkout areas. We're seeing that hit fast food restaurants more as well. That's not a surprise. With the McDonald's case, I mean, they still need people in the back, until robotics gets advanced enough that you don't even need people cooking. But certainly ordering and things like that can trim certain types of labor. and make that more efficient. So I do think that automation and AI is, it's already been a multi-decade trend. I mean, you can go back to the 2000s and the 1990s, and automation was already there in certain sectors. As it gets better and better, it can displace more types of jobs. I think that some of the recent advancements in AI we've seen can replace some types of, say, repetitive white collar jobs. Especially, give it a few years as it, sorts things out, gets more efficient, more accurate. I do think those are disinflationary kind of anti-labor technologies that take out certain efficiencies in the market, but then hopefully they create other opportunities elsewhere. So I think right now in the next several months we've been in a disinflationary cycle. I think we're going to continue to be in a disinflationary cycle. Now in the 70s, for example, you would have inflation come down from a high level to a level that is still pretty high. Yeah, and so inflation doesn't always go low in recessions. It just always, historically in the U.S. always goes lower. If you look at internationally, if you look at when you see emerging markets have recessions, sometimes they have a massive inflation breakout during recession because their currency works differently, right? Because they have liabilities that they can't print, and therefore they tend to experience different types of recessions. One thing that makes this period interesting is that there are tighter energy constraints now, and so you could have environments where Europe and the United States almost experience like an emerging market type of recession. That's more of a stagflationary type of recession where on the demand side you are experiencing a degree of disinflation, but it's not as though you're now completely oversupplied with commodities and all those things get super cheap. They could still be somewhat elevated in price while you have ongoing economic contraction, stagnation, things like that. The challenge is, so recessions, as you point out, are normal. It's normal for periods of excess to get wiped out, to take out businesses that are not really being productive. That frees people up, frees resources up to go do something more productive, figure out something new. And so that's completely normal. It also, wipes out bad debt from the system. The problem is that everything is so over levered now, and more importantly, leverage has gone up to the sovereign level. So what made 2008, for example, such a deep recession is that you had built up private sector debt for decades, and then that rolled over. A lot of that was then put onto the sovereign level. Basically, we somewhat delever the private sector. We put a lot of it onto the public sector. The problem now is that a lot of it's already on the public sector, and that tends to be a more inflationary scenario because they're still running. If you picture 2008, they were doing these like large rescue like packages that were like $700 billion, whereas in the current environment, the deficits are like double that going forward on an annual basis. I mean, it's like the baseline deficit now is like 1.5 trillion. And to the extent that the Fed is eventually forced to resume monetizing it, which we might have partially seen over the past month with, they're still doing quantitative tightening, but now they're actually adding more liquidity into the system than they're taking out. And so if you get back to a period of monetized large fiscal deficits of that scale, in some ways that's like a stimulus. But the problem is that it's an inflationary stimulus. And so on one hand, you have contractions in, I am concerned about commercial real estate. I would not really want to be working in, a fund that finances office space, for example. I wouldn't want to be in an unprofitable tech company. There are certain areas that I think are quite vulnerable. But when you zoom out, that's somewhat balanced by the fact that they're just doing these ongoing deficits that are just pouring more money into the economy. And so that's why I think it's a more stagflationary type recession. I think if you work in travel, I think if you work in, if you're a welder, if you're a plumber, I mean, a lot of these people are now making really good salaries because they're still in short supply, and they're somewhat recession resistant. So I really think that the severity of the recession is going to depend on the type of work you do, your role in the economy, and what type of assets you own. But in general, I expect it to be a more stagflationary type of recession, and one where inflation's ready to return as soon as policymakers are willing to try to get us out of that recession.
Investors will be closely monitoring the upcoming Q1 2023 numbers to look for any warning signs, given that job cuts are now hitting more established industries. If you enjoyed this video, be sure to click the like button, subscribe, and enable notifications. It's definitely worth doing the same for your own portfolio to guarantee you are protected against any volatility. Thank you so much for watching.